Are all set for today's session. Again, my name's Steve with Snap Projections. I'll be hosting and kind of filtering through questions throughout today's session. I'm joined as well by Lee, who's going to be in the chat filtering questions up to myself and Connor. She may answer your question directly in the chat, so watch for those if you submit any questions. Otherwise, we will address them live during the session or get back to you by email within the next couple days if we can't get to everyone as of today. We're also joined by Connor Mathers. So he's a financial advisor with CI Asante Wealth Management. Thanks so much for joining us today, Connor. Really looking forward to the chance to see how current Snap users are taking advantage of the software and using it within their practice. So thanks for joining us.
Yeah, thank you for having me.
Awesome. So I mentioned it just briefly. Please feel free to submit questions to the group throughout the session. We'll get back to them in one of a few different forms. We will also be recording today's session, so if you have to step out for a moment or if you want to rewatch it in the future, we'll send the recording to your email after the session is finished, and we'll also post that to our website so that you can find it in the future if you ever want to refer back to anything that Connor shares with us today. We will also be sharing a bit more information about how to sign up for Snap Projections if you're not currently a user. And we do offer a unique kind of raffle for anyone that signs up today. We'll explain more information about that at the end of today's session. And with that, we'll get into the agenda. So today, myself and Connor are going to be discussing how he uses his financial planning process to address client questions about inflation and investment return risk. Then he'll take us through Snap Projections and some of the plans that he's created to help clients make decisions about retirement timing and how much they can be spending in retirement. As I mentioned, I'll explain how you can take advantage of Snap Projections for your financial planning needs, so how to sign up, how to get started, and then we'll have some time throughout for live Q&A. So please feel free to submit your questions and we will get to those throughout. All right, so with that, I'll just start with the first question. So Connor, if you could kindly take us through just a bit about yourself and your practice, that would be really helpful.
For sure. So yeah, like Steve said, I work with CI Asante Wealth Management. I've been with the firm here for about 3 years. I've been in the industry working as a financial advisor for 6, and joined, like I said, Asante 3 years ago, joining a senior advisor who is 7-8 years away from retirement and looking to start a succession plan. So I jumped ship. Joined that individual 3 years ago, and really my role is I've got my own book of business with my own clients, but also working as a team with him and his clients. I do all the financial planning, all the Snap Projections for both of our clients, and yeah.
Awesome. And do you and the team have a kind of target client or an ideal client, and what sort of questions are you typically helping them to navigate through?
Yeah, I mean, we definitely have an ideal client. How would the way I would describe our ideal client is someone that is looking for advice, willing to take our advice, and is motivated towards their goals. That the not ideal client is someone that wants to come in and do a lot of stock trading and really be in and out of the market. We're long-term investors here. And we want to utilize our investments more as tools to make sure that we're reaching our goals. So that way, Snap Projections and our investments kind of work hand in hand.
Awesome. And with those clients, once you've identified a prospect, or for any of your existing clients who have a need, what sort of financial planning process are you following to help answer their questions?
Yeah, I mean, we like to keep things as simple as possible. Out of the gate, whenever we're starting the financial planning process, my first go-to is using the Snap Projection short questionnaire that actually you guys provide, and going through that, trying to gather as much information as I can, and that helps us as well as the client for getting them more organized, uncovering new assets, finding out how other assets are being invested and allocated, all of those sorts of things, which at the end of the day helps them answer their most important question, which typically is, can I retire? When can I retire? And do I have enough money?
Awesome. And aside from questions about retirement, I know over the last couple months we sent out a survey to our prospects and current Snap clients and asked what's most pressing for their clients. We heard back, a lot of clients are worried about inflation, worried about investment returns. So are your clients also voicing those concerns? And if so, what are they saying about inflation in particular?
Yeah, absolutely. I mean, with all the headlines going on right now, I don't think anybody's in the dark with where inflation is at. So it's definitely a pressing question, and understandably so, especially for those that are nearing retirement or in retirement, with how this inflation is going to affect their long-term spending needs. And short answer is that we believe that this heightened inflation is short term. But at the end of the day, we can use SNAP projections and our financial plans to start to kind of stress test their own situations and show them that, hey, maybe we need to be a little bit more flexible with our spending during times like now. This is no different than other market downturns, other than the fact that we maybe have some heightened inflation that's hurting us at the same time. But yeah, it's definitely a pressing question. And the way that we get around that or answer those questions is by showing them their long-term plan, and that this is short-term, that we don't need to panic and make emotional decisions during times like right now. We need to be stick with the long-term plan.
Right. Yeah, that makes a lot of sense. And aside from inflation, you mentioned it a bit that we're also experiencing a market downturn. So are there any specific questions about investment returns, either currently, going forward, and how are you addressing those sorts of questions?
For sure. I mean, it's no secret that this has been a difficult year for both equities and fixed income. So a lot of our retirees that are more in those balanced portfolios are experiencing some heavier hits than maybe what they've experienced in the last, well, especially the last decade. So the way that we're wording that is that if you're in retirement, you're not able to add more to your portfolio, now could be a good time to revisit asset allocation. And then we can input those kind of changes into the plan, and see how much of a difference maybe that makes in the future, and at least give our clients an educated decision of kind of what they want to do and what they should do, rather than just kind of going with gut feeling or making an emotional decision during a really difficult time.
Yeah, I think that's, having an informed decision that you can look back on and say that you did the best with the information that you had is really valuable.
Exactly. I mean, that's all we can do.
Yeah. And you mentioned quite a few different ways that you use snap projections to answer those questions. So would you be able to take us through some sample plans that you've done with clients and talk about what you input and how you use that projection to be able to address concerns and give them that peace of mind?
Yeah, absolutely. So I will share my screen now, and we'll go into a plan that I recently made for a client, and then I've just changed the names to myself just for privacy.
Mhm.
All right, so you let me know when you can see my screen and make sure that we can see everything.
That's coming through great. And
Okay.
just one quick note to everyone, please feel free to submit questions as Connor is able to take us through the plans that he's put together in Snap. Feel free to ask anything about kind of his planning process, the software, and we'll get to those once he's done.
Awesome. So this is where I'm setting up each scenario, inputting all of their information. All of this information, as we kind of go through this quickly, is what I gather from that short version questionnaire that Snap provides. It allows me to kind of uncover assets that are maybe held outside of our firm, start to understand how those are being invested, which can not only help obviously the plan, but help my practice as well by talking about consolidation and all of those great things. So always just starting out with simple information like their names, date of birth, where they live, and then moving into where when and they would like to retire, as well as inputting different inflation rates. So for this couple here, she's actually just retired, and he's looking to retire next year. Show the projections to age 100 for both of them. These are the default inflation rates that SNAP provides us. Now I can change these to be whatever I want. If you have an opinion that inflation is going to be a lot higher over the next 30 years, or you want to stress test your plan with a higher inflation rate over the next 20, 30, 40 years or whatever, you can always manipulate these. And then these are the rates of returns that I use for the individual's portfolio, and it will change for each individual based off of their asset allocation. I believe there actually is a little bit of, I think the default rate for cash is something like 2% or 1.5% or something like that. I always change it to 0 on here. That's just a personal thing that I do, because typically, unless we're looking at using like a cash wedge strategy, any cash that's on hand is usually being spent or invested into their portfolios. So that's the reason why I have it at 0. Moving on to income. So this individual, she just retired, does not have a defined benefit pension. He's got his employment income, a defined benefit pension plan that's starting. It's really important here for us to figure out or take a look at their individual pensions to get information on survivor benefits and indexing. So for this individual, he's lucky enough that he's going to have full indexing. Also, taking a look at what kind of bridge benefits he has. So for him, I think it was right around $840 a month that's going to be dropped off at age 65. And then depending when he's going to retire throughout the year, looking at either prorating this to be, based, a lot of people tend to retire right on their birthday or near their birthday. But for this plan, we're just showing them retiring at the start of the year. Moving on to assets. So this is, again, just filling in, how their assets are invested, what type of accounts they're in, the asset allocation that they have, and then, if they're holding these different accounts elsewhere, just describing those so it's clearly stated in the plan, so they're not getting too confused with all of these different accounts, because it can look a little bit confusing when we get to the main pages. Now, something that I do, I should say on here, assets. You'll notice that I don't have any real assets included in the plan, and I do this for a reason. Unless the client clearly states that they plan on downsizing or they plan on liquidating their home and going to renting, and they kind of have a set out plan of when and how much they plan on spending when they do that, I tend to try to run the plans without that. And kind of utilize that and have it in our back pocket for later discussions if needed, and I'll talk about that later on. Same thing for debts. For the most part, when I'm talking to my clients, they don't really want to get too in depth with, hey, how much spending am I going to be able to have for groceries, and how much am I going to be able to have to spend on vacations, and how much am I going to be able to spend on this, that, and the other, while also paying down this line of credit that I have and paying down my mortgage or this, that, whatever. For the most part, I think, like I said in the beginning, we like to keep our practice and our planning process as simple as possible, with still portraying the information that's needed. And at the end of the day, if I can give a client and say, hey, you said that you needed $6,500 a month in after-tax spending to cover all of your spending needs, and obviously you need to include that in your or your debt payments in that number. We're going to run it off of that whole number and leave the day-to-day kind of budgeting up to you. Then going into government benefits, so adding information for each individual on how much CPP and old age security they're expecting. If the client does have insurance policies, I don't typically use the term, but you can if you're really trying to make a full plan in here. But if they do have whole life policies or universal life policies that have cash surrender values, we will add those in. Can also add in RESPs. This client doesn't have one. as well as corporations. So for instance, this individual does have a corporation, but they did not want it included in the plan. They wanted to take a look at, hey, here's our individual assets. We want to kind of know how much of an income or the income that we think we need from it, is it possible, and leave the corporation out of it. And that's something that we might rediscuss later, bring in their accountant, take a look at how they plan on utilizing that corporation throughout the rest of their life, and then build it into the plan after. But it's always great for clients to at least get what I call kind of this skeleton plan, and then we can add in more information as we go and make it more precise and yeah, kind of really make the plan exactly how they want it.
Yep.
This is where we can add in different equity return allocations. So if we do have a client that's really specific to Canadian equities and high dividend paying fund or high dividend paying holdings, we might manipulate this a little bit. This is still the default. I leave it there. Again, if there is a surplus in the plan, if you don't have any empty accounts that you want to add it to, it will, I think, default to just adding it into a cash account, which would kind of mimic just their bank account. So I leave that. I change both of these numbers to 0 for each plan because, like I said, we don't want to plan on that money being there or getting a return, because typically when there is a surplus, a lot of clients will or tend to spend it. And then just making some changes to any registered assets that we have, of when we'd like those to be unlocked, and making converting RSPs into RIFs and all that great stuff. And then adding in any changes for tax credits and tax deductions. I typically don't change anything in here unless we know the information and it's consistent. So unless we speak with kind of the accountant or the individual or the client is really, really organized with all of this stuff, I kind of leave it as is.
Yep.
All right. So then it takes me to my planning page. And for this first one, this is always the very first kind of projection or scenario that I show clients. So for these individuals, they were asking and saying they need $5,600 of after-tax spending power per month. So of course that comes out to $67,200. And the way that this very first scenario that I show is always with what I always say straight line growth, which is the default for SNAP projections out of the gate. So you can see here that for each individual account, we're showing positive returns based off of their asset allocation in those accounts. So for example, this person or this individual spousal RSP 70-30, which I had in that scenario setup, versus their RSPs here, which I believe they have GACs. That's where the difference is coming from in each account. But like I said, just to go back to it, this is showing straight line growth for every single year, which of course we all know is not realistic, but it at least gives us an idea to say, hey, if we kind of average these numbers at least every year, are we even close to being able to spend the amount that we think we need based off of our assets and the way that we have it invested? And for these individuals, the answer is yes. So I'm able to go to the client and say, hey, out of the gate, when we just kind of take a look at a simple view, there's no reason that your $5,600 of after-tax spending is not doable. We show here that with that spending and with the average returns that we have in there, we should still have an estate by age 100 of almost 5.5 million. Now, something that I really take a look at here is making sure that these registered assets, these taxable assets, maybe in mid 80s, unless they have some health concerns earlier on in life and things like that, which this is always a fluid document that we're updating at least every year, that we don't have too much money locked in. And that really comes down to a preference as well. I've got some clients that want to pay the least amount of tax throughout their lifetime, and they're not as worried about estate tax. And then I have the exact opposite to say, hey, I'd rather pay a little bit of extra tax kind of almost every year to protect my estate later in life. And obviously you can bring in different insurance products and things like that to help with that as well. But if someone is just looking at how do I deregister my assets effectively and efficiently throughout retirement to make sure that I'm not stuck with too much locked up in my mid 80s, when likelihood of me being able to deregister that going forward is obviously a lot less.
Right.
So this is the first scenario that I always show clients. Simple, showing here's your estimated spending based off of what you've told me, your assets and how they're invested, with the average rates of return going all the way through, and it gives us a good idea that at least are we in a good spot to be able to retire. Is my spending too high? Is it too low? How will I actually get that money out? What accounts am I taking it from to make sure I'm not paying too much tax here and there? All of those sorts of things. Is there anything on that, Stephen, that you wanted to go over or me to answer?
No, I think that's a terrific overview of the base case, and I don't see any questions that have come in just yet on this plan. So I'll let you jump into the next version that you share.
Okay, perfect. So the second scenario that I always go to and show clients is the sustainable report. So instead of the previous scenario where it's showing, hey, you said you only wanted $5,600 a month or $62,000 or whatever it was per year, and all of that additional money going into savings, which in the previous scenario was going into TFSAs. This is showing, hey, what if we want to just make sure that we don't run out of money by age 100, but if we both make it to age 100, we kind of spend our last dollars that year. So what's the absolute maximum that we could spend based off of the asset allocations that we have with the assets that we currently have? Mm-hmm. So this not only gives me a good idea when I'm originally building the plan, kind of how tight or how fragile this plan is based off of, okay, what if we do see some big negative returns in the first few years of retirement, or if we see some increased inflation in the first few years of retirement or whatever. Because if this number was close to that 62,000, maybe like 65,000 or something like that, that's where it's a little bit of red flags for me to say, hey, yes, the last plan is definitely possible, but it's with straight line growth. And then when we take a look at the absolute maximum, there's not much more to be able to that you could spend per year. So that means that it's kind of leaning on those returns and the average inflation that we have built in the plan really, really heavily. Mm-hmm. So I always show this to kind of, show clients that, hey, you either have a large surplus or you don't. Maybe the amount that you're looking to spend every year is the right amount, or maybe we actually do need to be pulling out more assets per year on a tax basis. All of these different things that we can really dive into in all of these plans. Something else that I should note in all of these plans as well is I typically like to change asset allocation as we get older. In our practice, we've noticed that as clients get older, they tend to get a little bit or a little bit more sensitive to risk. They tend to want to de-risk their portfolio as they get older and older. So sometimes I like to just show that, especially since we're not showing any negative returns in these portfolios. So I'll kind of show that, and also I'll do it for non-registered accounts, showing that we're probably going to be triggering some capital gains. Now I know the plan does show, in this scenario setup, it does show like a 5% turnover in these portfolios as well for tax purposes. But still, if I've got a client like this that has, or had a large amount in non-registered assets, I'll typically like to show those assets being de-risked throughout their lifetime. So yeah, this is the second scenario that I always show clients, just to kind of show them the gap that they have or the flexibility that they maybe have in their spending.
Awesome.
third one that I've just started to add to kind of my planning process is starting to show clients historical returns. So Snaps provide us with this great tool that we're able to kind of select any period of public market returns dating back to all the way back to 1965, I believe. And we can manipulate, if we want to use 10-year returns, 20-year, 30-year returns, which can be great, for clients that are retiring at 50 or 60 or 70 or whatever, to be able to kind of play around with those numbers and stress test the plan that we have in front of us. So can do this one or two ways. Like I can change this back to a sustainable report. So saying like if we, I have it right now at the worst 30-year period since 1965. So that was from 1965 to 1995. And I'm showing this a lot right now for my clients because not only, you can take a look at here, the rates of return in public markets, 10.85, were actually pretty solid, but a lot of it was eaten away by inflation. So even though on paper we averaged 10.85%, in reality we actually only kept, beat inflation by roughly 5%, or roughly 6%. So still look pretty good, but it just goes to show that okay, if we had an exact mimic of the last or of that 30-year period, how would my portfolio perform, or my plan perform then? And based off of these random returns, as well as these these historical returns, as well as these historical inflation numbers, which I'm showing clients like, look, it's not the first time that we've seen these kind of numbers in history. There's been multiple times in the past that we've seen inflation numbers this high. So it does go to show or I think it really helps clients relax a little bit and say, as much as the news kind of scares us and we see like, oh, we're hitting, multi-decade high inflation numbers, what am I going to do? Am I even going to be able to retire still? Or if I'm in retirement, am I going to have to start spending a lot less? Am I going to have to go back to work? Like all of these different questions. This is a really powerful tool for me to show, hey, we need to stay with a long-term plan, because this isn't the first time that we've seen numbers like this. This isn't the first time that we've seen large negative returns like this, and we just need to stay put, make smart decisions, not emotional decisions. And this is also where I can show clients, I can start to manipulate things and explain to them that, if you're really worried about it, let's say I did this plan and we go down to the estate and it's showing, or it shows up pink for the last 10 years or something like that, showing that there's a deficit. That's where I might be able to tell clients and show them by going back up here and manually saying, okay, well, let's say instead this year, instead of Julie, you spending 32,000, what if we can cut that down and change this number to 55,000 for the next 2 years? If you think that's doable and you're not penny pinching, this is the kind of effect that it can make on your future, and really showing clients that not everything has to be weighed on just kind of letting your investments ride and still spending the same amount. You have some toolkits behind you as well to say, hey, I'm going to decrease spending for a few months, which was great in 2020. We did that with a lot of retirees, saying now's a great time to lower your monthly spending if possible. Or if some of our clients, like this one for example, where it's showing that there's a big surplus each year, like in that original plan with straight line growth, that okay, if you're not needing to spend all of that money, and you were able to save some in recent years, maybe it's a great time to start accessing some of that cash and stop your withdrawals. All of these different things. Yeah, so this is something that I've just recently added in to kind of my process, and I think it's been really, really helpful and really powerful for clients, and allowed them to kind of relax a little bit and say, this isn't the end of the world. We've seen this before, and we just need to keep making smart decisions going forward.
Yeah. Oh, that's great.
The last one that I just started utilizing as well is the random return tool that we have here in Snap Projections. So going in here, running a randomized report, and able to do the exact same thing, whether I want to take a look at the worst returns, or if I want to look at average or best case scenario, all of these different things. I don't always show a randomized report to clients. It's more about me being able to kind of stress test the plans behind the scenes and go into that conversation with whatever level confidence I have coming out of it in the plan. So if I'm starting to run a lot of these and I'm running the worst case scenario and average scenario, and both of those are showing a deficit really early in life, well, then that's where I need to start bringing in those conversations of being flexible with income or with their spending, decrease spending, pushing retirement back, working a part-time job in retirement, those sorts of things, or looking at liquidating or downsizing their current home if they have one. All of this different stuff. But it's just another tool that's kind of that we have available to us that allows me to kind of stress test these plans and show, okay, if we have the worst case scenario or the best case scenario, how big of a difference does that make in their, not only their estate, but their retirement spending and things like that. But it just allows me to play around with it and hopefully answer any questions that the client may have or any concerns that they may have.
Terrific. Yeah, that's been really helpful.
Yeah, and I guess the last thing that I'll say is that typically what I'll do with clients is if it's the first time that we've created the plan for them, I'll go through the first scenario with them in detail. And actually either, if they're in my office, we'll go through it on my screen. If we're doing it over Zoom or something like that, sharing my screen and actually walk them through how I've built the plan. I think they like to see, how I'm actually coming up with these numbers rather than me just, maybe giving them a report that shows charts like this. And I just say, yeah, this shows that you're going to be able to have that spending all the way through to retirement, and here's how we're going to build it in a graph, and it's all fine and dandy. But I think it's good for clients to be able to see the in-depth side of things and me be able to show them how I actually went in and built this and how it's going to work, but from account to account or whatever. So I'll go through it with them in detail. Of how I built it, but at the end of the day, they're usually walking out with a client report. So I actually, sorry. I'm usually going to them or I'm on this screen with them and saying, here's kind of the reporting options that we have. I don't want to overwhelm you with too much information or leave out any information that you really want to see. So I'll actually go through it with them in the report builder or the report editor here and say, this is what this page shows. Is that something that you want to take home with you and see? This is what this page is explaining, and whether or not, if usually the most important ones here for my clients are these cash flow and income pages, and I'll actually go through it with them from left to right, explaining that this is the amount that you're actually spending to be able to have that buying power. This is later in life, this is how much we're expecting you to actually need, and this is how we're building that income, whether it be through pensions, your non-registered assets, your RSPs, your TFSAs, all of that stuff, and then paying attention to make sure that we're not seeing big spikes or putting them at risk to be in too high of marginal tax brackets or putting their estates at risk as well, and letting them kind of have a little bit of say in, hey, this is what I want to be able to see, this is what I want to be able to take home because I understand it, and then later, next year, 6 months from now, when we update the plan, we can kind of compare that as well.
Terrific. Yeah, it's you've done a tremendous job of proactively answering questions that have come in throughout. So there was one about, where to find marginal and effective tax rates. So that's available either in the report or on the individual planning pages. Um, Another question quickly. We will be sending out a replay of this so you can refer back to anything that Connor's kind of referred to, and if you have specific questions, you can also send our support team an email or give us a call. In terms of any other questions, I'm just taking a quick scan through, and Lee, feel free to jump in if there's anything that
Sure,
feels
there's a couple of
particular.
questions that Connor might be able to answer with regards to how do you come up with the retirement uh, spending needs? Is that something that the client tells you? Do you work with them? Do you have an expense spreadsheet, or how do you do that?
Yeah, so I used to provide clients with an expense spreadsheet that they could take home and go through themselves. I definitely don't help them come up with their own budgeting. Um, I guess it would probably just because I don't really have the time to be able to um, sit down and go through their day-to-day expenses with them. I gotta leave that up to them. So I used to send home a budgeting sheet with them. What I found was most clients would not do it. They wouldn't actually go home and spend the time at looking at their most recent 6 months of spending or things like that. So what I do now is I typically leave it with the client, leave it up to them, and say, how much do you think you're going to need? Now, if I see a client that family in after-tax income right now is $180,000, and then suddenly they come back and say, oh, we think that in retirement, which is only 5 or 10 years from now or something like that, we think we only need $60,000. So there's a huge difference. That usually is going to open up a conversation to say, how did you come up with the $60,000 number? Is your lifestyle really going to change that much? What kind of expenses aren't going to be there that you're, building into that estimation? Because right now we're looking at, even with pension savings and your current savings that you have coming in here, you're spending $125,000 a year. What am I missing, right? But if it comes in somewhat reasonable to say, currently we know you're spending roughly $80,000 after tax, and you think that you're probably only going to need 65 or something like that, it's a lot closer. We'll just run with that number. But a lot of times we do have clients that say, hey, I have no idea. I've got no idea what I'm going to need in retirement. And at that point, we'll kind of take a look at their current situation and come up with a little bit of a guesstimate or assumption. If the client doesn't have a mortgage, doesn't have a ton of debt on hand, they don't have a ton of month-to-month expenses other than just what lifestyle expenses. Well, then we'll sit down and kind of run the numbers pretty closely to what they're currently spending, or we can kind of roll with that general rule of thumb of whatever you think that is, somewhere between 40 to 70% of your current income, and then build it off of that. And that's where we're really clear in our communication with our clients in terms of saying, we're making the assumption that you might only spend 50 or 60% of your current income in retirement, and that's what we're going to run the plan off of. So we'll have at least kind of what I call a skeleton plan to start off, and then I need to leave it up to you a little bit too to go home and do some deep thinking in terms of, hey, what do I want my next 10, 15, 20, 30 years to look like? And then come back to me and we can make any edits or any changes at that time. But the most important thing is, hey, let's get as much information as we can in the plan and have one to start out on. And then we can always add and edit information as needed.
Mm-hmm. Yeah, and I'll just take a moment because Connor, you had this happening in your plan, but I'll show it quickly just in a demo client here. Um, Snap helps to get that current spending level
Yeah.
by entering in the client's current situation. So in Connor's plan, he had entered the client's current employment income and then any of their existing savings and debt payments. And then the software kind of says, okay, given their current lifestyle, they're probably spending about $53,000 a year. Unless they've missed telling us about something, that's what we can go off of. And then in retirement, we can, say, are you expecting to spend more than that, less than that, equal? And then just as Connor had done with kind of having multiple plans, you can say, well, we'll assume you're going to spend 60%, but if their sustainable spending is that they can spend 110%, then there's less of a need to refine those budget numbers, the more room there is in the projection. So I think it kind of comes down on a client by client basis, how much budgeting work needs to go into the plan to be confident.
Absolutely. And that's exactly where I get that kind of current spending from, is from the SNAP projection after tax spending in the current year.
Awesome. Any other questions, Lee, that have come in?
Yeah, so this is a common question, and you kind of touched on it a little bit, Connor, about the deregistration strategy and how what is SNAP's default order of withdrawals, and do you typically use that default? You just base it on the client specifically? How do you set your projections up?
Yeah, so actually, Stephen, you might be able to answer what the default is.
Yep. Yeah, so when you create a plan initially in SNAP, we've input a default drawdown strategy that uses withdrawals initially coming from non-registered assets, then from tax-free, and then from registered. And what we often find, you can see those withdrawals coming out of the non-reg, then once the RIF minimum kicks in, it blends the RIF and non-reg. Once the non-registered runs out, it blends TFSA and RSP. And so this generally creates a fairly blended, consistent marginal tax rate. If we look on the right-hand side, you can see, aside from their first few years of retirement before the RIF kicks in, they're at a fairly consistent rate. So the default is based off of CFA research around what drawdowns are most likely to be successful for a client, but then you can go in and customize either with a standard default that you want or with a client by client adjustment for withdrawals.
Yeah, so I, for my, most of my projections, if the client is saying, I think I touched on this a little bit earlier, if a client comes in and says, my goal with my retirement spending is not only obviously to figure out to make sure I have enough, but of course, no one wants to overpay in taxes. And I start that discussion out by saying, there's two different ways that we can kind of overpay in taxes. And that's either through not being or not being efficient with your deregistration throughout retirement, and maybe pulling out too much or too little. And the second one is if we are pulling out, not enough, then it puts your estate at risk. So it really just depends on what their priorities are. If their priorities is to leave, as large of a estate as they can, while not paying an insane amount of tax throughout retirement, well, then we can fine tune the plan by using that CFM order that you've got there. And I typically change that to registered, non-registered, and then tax-free. Unless the client is saying, I don't care, I don't really care as much what my estate tax is going to be, and then I'll kind of leave it to the default. But at the same time, I'm always, playing around with those different scenarios and taking a look at those marginal and effective tax rates on the right-hand side. And if anything jumps out at me to show, hey, if we start doing the registered too fast in retirement and those numbers are too large, it's jumping them up 1 or 2 tax brackets, well, then I'll play around with the numbers a little bit more and say, okay, well, maybe we still try to deregister these as what I like to say as aggressively but efficiently as possible. But we may need to tie in some deregistration from TFSAs or pulling from non-registered investments as well. So it is a case-by-case basis, but a general way that I run it is usually with that CFM order for the withdrawals being registered, non-registered, and then tax-free. And I usually find that the marginal tax rates, for the most part, stay about the same for at least the first, whether it be 10, 15 years, but then allows them to have a larger or a much more tax efficient estate, starting in like their mid 70s or mid 80s, depending on the situation. So if I change it to registered, non-registered, tax-free to like what you did there, and I see that marginal tax rate staying at the same, I'm much more likely to recommend that we start deregistering that with those amounts or whatever. And then, you know, as you can see, at age 86 there or whatever, the marginal rate's dropping down to 25. And I'll start to pay attention to, okay, at 80 and 85, how much registered assets do we still have in the plan, or how much capital gains are we still going to have in the plan if we're not withdrawing from non-registered accounts early in life.
Terrific.
Hope that answers your question.
That's great.
So maybe I'll pause there just for a moment, Lee. If any other questions come in, we can address those shortly. But I did want to take just a moment to kind of chat about for any current prospects of Snap that are interested in learning more about the software. We do have a 14-day free trial, so please feel free to go to our website, sign up for the trial. There's no initial payment, and we do have a 30-day money-back guarantee, so it gives you a chance to make sure that the software is the right fit for your practice. When you do sign up, there's a one-on-one kind of training session that you'll have available that you can book for a convenient time. You'll have access to all of our video tutorials, things like these webinars that we record on a regular basis. We put those up on our website so that you can refer back and learn from other great advisors using the software. We also do, on the customer success side, we do a lot of training videos about new functionality. We have one of those next Wednesday that we'll be sending out an email for tomorrow. So lots of existing resources. And then we also have a dedicated support team that you can give a call to or send an email to. And we just, love helping, love making sure that you understand the software and are taking advantage of all the capabilities that it has. And then we have, as Connor mentioned, we have a lot of client-facing materials that you can use once you've signed up. So in our help center, we have things like client questionnaires. So you can, download a Word document and it looks like this. So you can customize this with your own logo, put in your advisor information, and then use these data gathering tools to make sure that you have everything that you need to create a full plan in Snap. It's got a lot of qualitative and quantitative data gathering, and then you can take that, it's in the same order that you would enter it into Snap projections, so it flows nicely. We also have sample plans, so you can download this and get a sense of how you can share the information in Snap with your clients. We have one-pagers that might help existing clients to sign on for doing a plan. Some clients know the value right away and they're keen to do it. Others don't necessarily know what's involved and what they would get out of it. So these sorts of resources can help you just incorporate financial planning into your practice and identify new opportunities with existing clients. Or we hear from a lot of advisors that doing these plans really helps to gain referrals, and clients will actually talk about their plans with their friends because for the first time in 20 years, they actually have confidence and a known kind of path forward of where they're going. So we have other webinars where advisors have come on and talked about just how many people they get to be introduced to because they've created plans for their clients. So in terms of signing up, you would just go to snapprojections.com, our website. There's a pricing section at the top. We have 2 plans available to give you as much flexibility as possible. You can do the advisor professional service, which has access to all the main functionality of Snap projections, except for the corporate planning. So Connor kind of showed us where you can enter a client's holding or operating company and plan for those assets to be included in their future spending needs or as part of their future estate. So if you'd like the full access to all functionality in Snap, that would be the advisor business, which is the most common, but we do have both options to give you more flexibility. And you can either bill monthly or on an annual basis to save 10% off of the cost. And then for anyone that does sign up today, we put all those names into a hat and we draw one out, and that person will get dedicated onboarding. So we have, I like to say, as part of the success team, we have great onboarding for all clients. There's that one-on-one training for everyone that signs up. There's our phone and email support, but we do have a very structured kind of process that we can take one person through in order to get to know their practice, get to know what they're looking for from Snap, and really tailor an onboarding to their unique circumstances. So we'll reach out to whoever wins that, and that's just based off of anyone that signs up for their free trial as of the end of today. So with that, if you have any questions about getting started, please feel free to send us an email. You can reach us at support, or you can give us a call or send us an email at support@snapprojections.com. Alex will also be reaching out to you as a follow-up to this to see if there's any questions and see how she can help. So please feel free to let us know if anything comes up. With that, we do have about 9 minutes left, so keen to get back to any questions that have come in for Connor while we have them. So I'll see with Lee if there's anything else that's come in.
Yeah, so Wayne had a question about the tax rates to see why you kind of focus more on the marginal tax rates than the effective tax rates. He just looks at the other. He's just wondering a bit more about that.
Yeah, I mean, I definitely look at both for sure. But if we can, stay under the next tax bracket while still being efficient with our withdrawals throughout retirement, I'll do it. But at the same time, I will say that I always leave it with clients to kind of that if taxes are a big part of their retirement plan, so usually for wealthier clients, I always try to involve their accountant as well. So I don't have my CFP yet, plan on getting it. But I always say this is a projection for us to be able to show, is your retirement spending needs possible? If we really want to get down to the nitty gritty of, being as efficient as we can, it might be a good time to, include your accountant and include the tax planning strategies that you have in place. And then we can customize the plan and revisit it and edit all of this information based off of that as well.
Yeah, that's a really good point, because I think what often happens is, even if you can get the marginal tax rate or effective tax rate, whatever you're focused on, if you get that to the exact precise amount that you want, I think changing the rate of return assumption from, say, 4.5 to 4, that's going to have a larger impact on the plan than any tax planning in terms of the overall success. So, Snap really helps us to get an overall view of where things are headed, and then on a year-to-year basis, that's more so where the true tax planning can come in, when you have all of the information, all the current tax rates, all the account balances, everything that they need to make those trade-off decisions. They can do that, more granularly with their accountant on a year-to-year basis.
Yeah, definitely.
Awesome. Any other questions, Lee, that have come in?
Yeah, there's been a lot of great questions. I did answer most of them just directly, but maybe just for benefit of other people to hear what some of those questions were, just about how to maybe turn on that CFM order column. I think just to show again how that works.
Yeah, so because it adds a bit to the planning page, which can already be, a lot of columns, we allow you to quickly add it and remove it from a plan. So within the capital assets header, you would click on this box and then say show the CFM order column for this scenario, or show it for all scenarios. And then that way, it's always turned on for all of your plans. You don't have to worry about turning it on and off, but it's under the capital assets, and then you'll see here that you have control over customizing those values.
Great. I think another question was about, is there anywhere that's your input values are stored? So that was a good question, that you can actually export this projection to Excel if you'd like to, I guess, manipulate it yourself too in an Excel spreadsheet. But the Excel export has an input parameters page in it. So that basically will allow you to just double check what you used for various assumptions and inputs right from the beginning.
Yeah. So it starts off with a summary of the main planning page that you're used to in the software itself, and then it has a separate tab for all of the individual input parameters that were used to create the plan. So if you ever wanted to recreate it or refer back to how you got to a particular number, all the parameters are here. And then there's also lots of information in the report. So if you go to client report and then into the assumptions page, you can see a lot of the input parameters here as well. Things like inflation rate, when this projection starts and ends, investment returns, individual account returns, and then government benefits, things like that. So the most relevant and plan driving or material assumptions are here, and then the remainder and those as well are in the Excel file.
Terrific. And then I was answering a few questions, so I'm not sure if you maybe already talked about this, but just that you can pull up the estate summary and compare between multiple scenarios. Like how you would compare two scenarios was basically the question. And you probably already talked about that, but I just wanted to check.
Yeah, we didn't have a chance to specifically refer to the estate before tax. Connor kind of mentioned that you can go to the bottom of the plan and look at the estate and then say, in this one, you're expected to have 2 million, I think it was for his base case. And then in the, worst historical period, it was in one of them, it was 4 or 5 million. So you can get a sense of what the differences are in the plans. The other option, and I think I saw a question about adjusting the plan and figuring out what approach is best. But if we copy this scenario, and then if I just make a couple of changes, so instead of taking out 40,000 a year, I'll take out 25,000 from the registered account, and that's just going to prolong that taxable income. It's going to smooth out some of the period. So in this case, this might be a client that's less worried about their final estate tax and more worried about the tax that they're paying over their lifetime. And so in this case, if we go to estate before tax column and click on this teal blue box, we can compare the two plans together. So this was the first plan where we were taking 40,000 a year out of the RIF right from the start of retirement. They were expected to have about 545 in today's dollars, 1.3 million in future dollars after tax. And then just by prolonging their RSP drawdown, we could increase that to 1.5. But this is looking at the final estate where they've lived to age 100 and they've had a chance to tax efficiently withdraw all throughout. If we looked at, say, age 70, if they were to pass away early, we can go to age 70 in the estate before tax column, click on that value and compare here. And we see that in this case, their estate after tax is actually higher if they were riffing faster, right? Because they've gotten more of that taxable income out at a lower tax rate. So this allows you to show clients how different decisions impact their plan at different points in time, depending on how long they live. So again, it's the estate before tax column where you can do those plan comparisons.
That's great, Steve. Thanks.
Yeah. So we are just at time. We've got about a minute to close out. So once again, there will be a recording sent out. Really want to thank Connor for joining us today. I was thoroughly impressed. I had a chance to get a preview of what he was looking to talk about, and it was more and more comprehensive and kind of refined than I could have possibly expected. So thanks, Connor. Thanks for sharing all that with us. Thanks to everyone who joined us today. Once again, if you're looking to sign up, you can go to snapprojections.com, go to our pricing page, and then sign up for a free trial of either the Advisor Professional or the Advisor Business. And then I'm sure that we'll chat as you get onboarded and send in any questions that you might have. So thanks again.
I just sent that link out to our chat as well, the sign up.
Perfect. Awesome. Well, thanks everyone for joining us today, and we'll chat again soon, I'm sure.
Great. Thank you.
Thanks, Connor.